Well, it looks like the economy is starting to slow down just a bit. Now, it's been on this unsustainable tear for the last 3 or 4 months. It's just historic. It's no reason to be afraid. It's going to go back to normal, but it doesn't look like inflation is going to slow down. So let's go to my chart and let's talk about this. Now, we just received this today for June. It's the ISM Business Barometer. It was at 75.2. That's a historic reading. And when we say historic, that means you don't see that very often. We see this every once in a while. You have to go back a long, long ways. I think this is 2015 before you even got that high. And then going back even further, I think we had to go back to like 03 or 04. So this, when they say historic, it means it doesn't happen all the time. So we're at 75.2. When you're at historic, it means it probably won't stay that high. And you're seeing some things in the news saying it's dropped and dropped precipitously. Well, yes, it did. It dropped from 75 to 66. It ruined my forecast. I thought second quarter we were going to be double digits. With this drop, it's going to knock me out. So I'm not going to get double digits. So it's probably somewhere between 8.5% and 9.5% GDP. But what a wonderful number that is. What an absolutely incredible number it is to say you're disappointed that you didn't get double-digit GDP. I mean, that is just laughable because at this rate, it's just incredible. Sure, it dropped, but it's dropping from a point that's truly unsustainable. We can't sustain this type of level. You know, in the real estate business where I am, we get a house come onto the market that's in our price range and it fits into our parameters. By noon, it has 4 or 5 offers. By 5 o'clock in the evening, it's got 20 or 25 offers. This is truly not normal. It's unsustainable. It's really bad for business anyway. And this is across all different asset classes. So we're going back to normal. Now, when we're looking at a GDP that's looking at maybe 8.5 to 9.5, it's triple or quadruple what normal is. Most presidents, if they can get one quarter where they're doing a 3% GDP, they just feel like they have been vindicated. They think that this is just wonderful. And here it is, we get 2 quarters back to back that are 6.4. And I think we're going to get the second quarter probably somewhere between 8.5 and 9.5. This is just incredible. So you're going to see this in the news that the economy is slowing down. Yes, it's slowing down, but it's slowing down to normal, and normal will be just fine. We're going to love normal. Normal is just great. So let's take a look at my next slide. This is the ISM manufacturing. We're still up here over 60 on both the market and ISM manufacturing. Manufacturing is doing very, very well. The only thing that's constraining manufacturing, I think, is a lot that has to do with some shortages in some key components. And of course, everyone has heard about the fact that we're missing microchips in a lot of our devices. And because of that constraint, we're not able to produce as much as we like, which I think we'd probably break into double digits if we had that ability. But everywhere you go, there's backlogs. I mean, everywhere there's container ships sitting off the coast of Long Beach just waiting to be unloaded, and it's historic. So when you're at historic level, it's historic because it's not normal. So we're just heading back to normal. So we're still up in the 60s. You know, if you're over 50, you're doing very well. It means the economy is expanding, and we're over 60. Most of the time, if you get a PMI somewhere around 52, 53, 54, people are incredibly happy with that. And we're way above that. So the economy is doing real well. You know that manufacturing, construction, industrials, IT, the real estate business are just really incredibly on fire. Now you hear all the stories about rentals and the builders just cannot build enough homes. And this is because we have a shortage across the country. There has been really, the builders have been very, very cautious in building because they really just got slapped in 2007, 8, and 9. A lot of them lost tons and tons of money. And not only did the builders not want to be were being very conservative, but the lenders are being very conservative too, and consequently we have a shortage across the country in my industry. But that is bleeding over into automobiles and into refrigerators and air conditioners, furniture, all kinds of things that are manufactured. We have shortages. And of course, here in the United States, we're open. A lot of places around the world are not. So let's go to my next slide. Let's just talk about that. Now, this is coming from the business prices. So they're talking about the report on manufacturing. So you can see here, now the red line is the manufacturing. This is us coming into the COVID recession, just drops and then starts to recover. Here we are, look like we're recovering. And here it is in this last couple of weeks of the quarter. We're starting to see where it dropped, and this is where manufacturing has really slowed down a lot. And here we are finishing the quarter. We just got a little bit of an uptick, but the green line are prices paid. So you see absolutely, you remember the spike, we've talked about the spike, but this spike in prices paid, again, another asset class, another one of our charts, is showing no decline whatsoever. Even though manufacturers started to slow right at the same time, you did not see prices slow at all, which leads me back to inflation. So yes, it looks like manufacturing and industrials, we're just starting to normalize a little bit. We're slowing down to something that's much more compared to normal. The inflationary environment is not. So now you're hearing a lot of questions saying, well, this is transitory. Well, I'm not sure what transitory is. Bank of America came out with a research paper saying they thought we'd have transitory hyperinflation. Well, there's two phrases I'm not sure of, transitory and hyperinflation. What exactly is hyperinflation? Is that just a lot of inflation? But when you read the research paper, it turns out that transitory is 4 years. Well, 4 years is really not transitory. That seems to me to be more like an inflationary cycle, which goes back to one of my cycles. And of course, this is part of our research. So let me go to the next slide and let's just talk about that. And we can see where this fits into our cycle, because we're seeing prices across the board are accelerating. They're not decelerating. We have no slowdown in inflation. If we had just kind of like an inflationary transition, I would think we start to see things start to slow down here. And again, in the ISM prices, we have absolutely no slowdown whatsoever. You can see it goes way, way back before we see this type of acceleration all the way back into the 70s. And we know what happened in the 70s. Now, if we're mimicking the 70s, and that is what we're going to do, because if this becomes a full-blown cycle rather than a transition, I think we're going to see prices across all asset classes really rise. You're also going to see interest rates rise. Rising interest rates for we as baby boomers is very, very difficult on us, because if you're looking for income, and a lot of you are in bonds, rising interest rates just decimate a bond portfolio. They're very, very hard on a bond portfolio. There's that inverse relationship. If you're looking for income, you might do what a lot of the pension funds have done, and that's to transition into some real estate in your portfolio, because real estate gives you a cash flow that will maintain its purchasing power and increase in an inflationary environment. That's what a lot of pension funds and life insurance companies are doing right now. We're seeing a lot of activity with a lot of the major REITs are coming in, and you might consider doing that. So let's just talk about our next slide, and we'll talk about what we see in the marketplace. Now, we have made a lot out of my business cycle model. I'll tell you that we're here in the middle of this is the accumulation phase. This is kind of a wider portion right here, this little graph. This is really when fortunes are made. This is when you should be accumulating properties. As I mentioned before, this is coming up a statistical analysis on it and doing some cycle research on it. This is what we come up with. Oftentimes it tells us what's going to happen, doesn't necessarily tell us why. We wait for the economy to tell us why. And we're going to transition from the accumulation phase into the explosive phase. And right here is when you make fortunes, where we are literally right now. You can make an absolute fortune. That's why I'm pleading with you to go out and buy a house. But right here we get the explosion. So there's many scenarios. My chart shows us that prices are going to go considerably higher. I don't necessarily know why. I'm just showing what my model is showing. It shows much higher prices when we go to get into the explosive phase. This should be right around 2004 through 2005. We may very well go into a bubble territory. If indeed we're going into inflation, that would be one of the reasons that would happen for us. I can think of a couple scenarios for it, but inflation certainly would be one of them. And if you're a baby boomer, like most of my clients, and like a pension fund, you just need to be very cognizant of the fact that inflation destroys your purchasing power. And if you don't protect that purchasing power, you'll be left behind. $10 isn't what it's used anymore. I remember as a kid, we used to buy gasoline for 28 cents a gallon. And it went to 35 cents, and everybody was just shocked because that was a 20% increase. And of course, you just love to get 35 cents. And around the country, here in Maricopa County, we were pretty close to around $3 a gallon. Other places in the country are paying much more than that. And if we get inflation, you could very well be paying $6 or $9 a gallon. And if you don't protect your income, goodness gracious, you could just be left behind, because we're going to live a lot longer than you think. Us baby boomers, we're going to be around for a long time. Just tell your kids, hey, look, I'm going to be here a long time. Let's look at my next chart. Now, this comes out of National Association of Realtors, and they're talking about net worth comparisons. The difference between a homeowner and a renter is stark. So if you're a homeowner, your net worth is somewhere north of $250,000. And this is a couple-year-old chart, but the difference and the index is just the same. So maybe it's around $260,000. The renter really is around $10,000. So owning a piece of property is a huge investment and financial gain. It's one of the best things you can possibly do to protect yourself and to build your net worth, is to buy a piece of property and own your own home. There are so many advantages to you owning your own home. We go into demographics. It doesn't matter who you are, the comparisons are the same. Those that own homes, their net worth is much greater than those that rent. So it's just obvious. It's just absolutely obvious that you need to go buy a property. We've been preaching this. And if you're my age, 75 years and up, their net worth is north of 250. It's probably close up to $300,000. And it's principally done because you own a house. You can't get a better comparison that you need to go out and buy a house. Now, I know how hard it is. I know how difficult it is to come up with a down payment. I understand that if a VA or an FHA, or you're 3% or 5% or 10% down, I know how difficult it is. You need to go make offers. Go find a broker, go find a realtor that's going to help you with this. Go buy a property. If you're my age, go help your kids or your grandkids, gift them the down payment. And if you're my age, you need to own a home. If you own a home, you have to have at least 2 rentals in your portfolio. Now, if you follow my work, if you've got 10, then your life is going to be on easy street, but just 2 is going to make a huge difference. It's easy to get 2 properties into your portfolio, and we are going to live a lot longer. I have tenants that stay in my properties for 15 years. They've paid over half of the mortgage off for me. This is just great business. I'm pleading with you, go buy a property. If you're in Arizona, give us a call. We're more than happy to help you. We are very good at it. We're here in Scottsdale. We have positions in Phoenix, all over Maricopa County, and Peoria, Gilbert, Chandler. We're excellent at what we do. We'll work with your financial advisor. We'll certainly talk to you and your spouse. Let us know how we can help. Let me go to my next slide, and we'll talk about that one. You got to get a single family home. Now, here in Maricopa County, we are loaded with these 1,500 to 1,800 square feet. We're seeing these prices go up 3% a month, 3% a month. And I have people tell me all the time, well, it's going up so fast. It's going up at 3% a month. Well, of course, you want to purchase a property in an appreciating marketplace. You don't want to buy properties that are going down. You don't want to be in a marketplace that's losing value. You want to be in a marketplace that's gaining value. And I'm going to tell you, my model is showing prices are going to go considerably higher from here, even with these prices where they are. So go do this. Interest rates are just unbelievable. They are really, really good. They're very favorable, and you can purchase a home for less than what you can rent it for, which makes it really, really good for us. That means we get cash flow on our rentals. We have huge demand for housing. Take advantage of that. Go to my next screen. This is where I get to have a little fun. Ask you to give me a thumbs up if you like my video. If you would subscribe, it really helps with our marketing. I'm an author. I've written a couple of books. Real Estate Investing for Beginners is just going to take you by the hand, take you through financing. It's going to talk about not spending money. It's going to talk about reviewing all of your costs, all of your income, and see if you can't reduce your costs and increase your income so that you can come with more capital. Because you have to remember this: who are you making wealthy? Are you making yourself, or are you making someone else wealthy? And if you need to reach me, I'm at michael@michaeldeville.com. So let me just recap. We're probably going to slow down a little bit. It's still going to be above normal. Business is going to be very good. I think we have more than just an inflationary period here. We probably are entering into a full-blown inflationary cycle, in which case it's not transitory. It may very well be one of the catalysts that drives prices considerably higher from here, which would give you all the more reason not only just to be a homeowner, to really get your net worth up, but to preserve your purchasing power, just like the big guys, just like the pension funds and the insurance companies. They're transitioning into real estate and getting out of bonds because they want the cash flow and the purchasing power. And I'm here in Maricopa County. We have a great staff. We really know our business, a great reputation. If we can help in any way, we certainly will. Have a great 4th of July. Bye-bye now.